There we go.
Good morning. Thank you for joining us on this lovely Friday morning to talk with our tax expert, Trey Chandler. And Trey has been in the accounting world for almost
A long
30
time.
years, a long time.
30. I'm not that
Uh,
old, but I'm that old. 30 years.
so Trey currently has his own business. He works with small businesses as an accounting, like he can do CFO to go services or consult. Currently, it's tax season, so he is elbow deep in tax preparation. And we thank you for taking a few minutes out of your day to talk with us and answer some questions that have been posed.
Glad
Um,
to do it.
I want to just jump right in and
Okay.
start with question number one, and that is I'm married, but we keep our finances separate. Can we file as single on our tax returns?
All right. This is a good question because it allows me to kind of get on my soapbox about people who are married but keep their finances separate. Uh,
Okay.
so there's general reasons why that's not a good idea, uh, and all of them are true. And I've yet to see anyone, a married couple, who keep their finances separate, who make it work. Sometimes it's temporarily works, and this a lot of times if there's yours and my children involved, or if it's
Mhm.
a previous marriage, sometimes people kind of get burned, and so they want to keep it separate. But I find that a lot of times people win better when they combine it. But that said, you can file your taxes separately. Now, you wouldn't file as single because you're not single.
Okay.
And the thing on the different from your withholding forms when you fill out with your employer, you don't have to tell the truth on that. That's just a guide for withholding. But on your tax forms, you always have to tell the truth. So
Hmm.
you can't file single if you are married. You can file married filing separately, and your tax preparer will, in most cases, it's built in when they put your information into their software. They'll say, okay, this is the primary taxpayer's information, or then this is the spouse's information, and the software will run the comparison. Is it better for them to file married filing jointly or married filing separately? Now, I will say this: I've been doing this for a long time, and I've never seen a situation where married filing separately gives you a better tax benefit than filing jointly. Now
Okay.
that's on the federal side.
Hmm.
On the state side, speaking about Arkansas specifically,
Hmm.
it's the opposite. It's always that I've seen people married filing separately on the same return, and it does it automatically, is the better option. So
Okay.
you'll see two columns in there. It'll say taxpayer and spouse, and you just the information flows down there. But that's just how it flows out. It's not a comment on marriage or their marriage or anything like that. It's just this. It's federal married filing joint, state married filing separately on the same return. 10 times out of 10 is going to be your best bet. I'm sure there's an exception, but I've not seen it yet.
Okay. All right. And that does apply. We are talking Arkansas as
Is
far as
so
any
everything's
state
Arkansas.
information
Okay,
that we discussed today. So
good.
the next question is, what are qualified education expenses?
Qualified education expenses. So I'm assuming we're talking about college in general. So I have my youngest is just graduating from college, so we're in the middle of this now, and we have been for the last few years. So it's generally what you think it's going to be. It's it's tuition and fees and books. A lot of people want to say room and board, and that doesn't fit. There's an element of transportation in there, but it's not what you think. You can't buy them a car and write it off on your taxes. And a lot of times it's going to be you're going to get that information from the school. The institution will send you, here's how much you paid for your,
Okay.
and you'll plug that in on your return that way in the form that they send you. And it's less any scholarships. So if you get a $15,000 scholarship in a year to a school, and the expenses were 13, and they refunded you that $2,000, you don't have any education expenses because they paid for it. So it has to be
Okay.
something that you paid on your own to the school. That's the general guideline. It's a good way to do that. It's like if I didn't pay it to the school, it probably doesn't count.
Okay. So if you bought books maybe through an online vendor, you just have to keep those receipts.
Exactly. The books do count, even if you. That's a good point because we've done the same thing. Sometimes you buy them from the bookstore because you have to, because that's the
Mhm.
only way that they're available or something.
Yeah.
Or if you buy them through a third party book vendor,
Mhm.
you just keep that receipt and you plug that in there with that. That's a separate line item on the return. You'll say tuition and books. It kind of lines out what you need to. What you need. And your preparer, if you're not doing it yourself, your preparer should ask you those questions.
Okay.
And if they don't, maybe look for a different preparer.
All right. All right. The next question, who can be claimed as a deduction? So while your children are in school, they're still considered a deduction, correct?
Okay, I'm assuming this means who can be claimed as a dependent.
Yes.
Okay, yeah, because a lot of times folks will say, "Well, I pay for my parents' health care or something. Can I claim them as a dependent?"
Mhm.
And the short answer to that is no. But it depends. Is kind of most of the answers. But you said it just right. It's like when your child is at home with you, that's an easy one. That's
Mhm.
always going to be true because they truly are, in every sense of the word, a dependent. But the IRS has these 5 tests that you have to apply to whether or not someone's a dependent. Some of them are kind of slam dunks, some are more obscure.
Okay.
But one of them, the big one to do is like the support test. Is if you pay for more than half of the support for an individual, they could be claimed as a dependent. So your child living in the home with you, you're obviously paying all of theirs. They're not paying any of it,
Mhm.
and so that would count. Now, support also would include things that they may get from the government. Like if your child has SSD, Social Security Disability, or SSI for some other reason,
Mhm.
that counts towards their support. So you have to factor that in. So, but generally, a child living at home is going to be fine. But like if you're supporting your elderly parent who doesn't live in the home with you, that you can kind of think about, is it half of their support from all sources or not? The
Mhm.
other is there's a gross income test. If they make more money than the exemption is, then that will disqualify them.
Okay.
Unless the child is 19 or younger, or 24 and a full-time student. Like my son is a full-time student still. He's in college and he's about to turn 22, but he's still my dependent. Even though he's not living at home, he's in my household. We're renting a house for him in college.
Mhm.
So while your kids are at college, you're still probably going to be a dependent, most likely, unless they're on their own. So that's the second one. The third one is a member of household relationship test. That's an easy one. Are they your son? Are they your daughter? Are they sometimes if it's your brother who's living on your couch because he's unemployed, maybe. If he meets the other tests. So you have to meet all the tests, but that's one of them, is a member of your household.
Mhm.
They can't have filed a joint return with someone else. Back to our first question.
Okay.
If they're married, but maybe they're separated, they would have to file separately on a different return. Or if you have a married couple living in your home, like it's your brother and sister-in-law, and you want to claim them because you're helping them out, they can't file jointly if you're going to claim them, or vice versa. If they file jointly, it automatically excludes them from yours. And the
Okay.
last one is they have to be a citizen or resident of the United States.
Okay. I want to go back a little bit. We have a lot of people in our community who they're raising their grandchildren.
Mm-hmm.
Do you have to have a guardianship in order to be able to claim that grandchild as a dependent?
No, no. If
Okay.
they're living in your home and you're paying more than half of their support, in most cases, the rest of those things are going to fall in line, and that child's going to be your dependent.
Okay.
Now, a lot of times there's legal agreements between the parents. If one parent has legal custody,
Mm-hmm.
and the ex spouse, maybe they have an agreement of, I'll claim this kid, you claim that kid,
Mm-hmm.
and then there's forms you have to file with all that says, okay, we're gonna uh, I'll claim them this time, and you claim them next time, or something like that. I've seen those
Mm-hmm.
situations, so they'll need to coordinate that with the parents if they're around. If
Okay.
they if they're out of the picture, then yeah, the grandparent can claim that grandchild.
Mm-hmm. Okay. Yeah, I know I've seen divorce decrees specifically label out who claims which dependent or
Yeah,
ev-
it, and that
every
can
other year.
like most things in divorce, that can get messy.
Yeah.
They'll some kid will they'll sometimes they'll claim a kid one year. They'll just agree to do it, and there's no written documentation, and then they'll both claim the same child, and then it can be a mess and another reason to fight, and we don't want that.
Yeah.
Keep it all
Keep it
nice and clean.
keep it easy.
Yeah, as best you can.
All right. This might be the most loaded question we have, but in our current economy, it's the way things are
Hmm.
kind of headed. Um, Side hustles. How does that affect taxes?
Well, just like any other income, you know, it's it's you know, how do I say this? Uh, I get this question a lot, and people think that they say I don't want to make too much money because then my taxes will go up.
Yeah.
And to what I say, there is no 100% tax rate, so more money is always more money for you.
Mm-hmm.
And sometimes the government will take a higher percentage of that if you make a lot more money and you go to the next bracket,
Mm-hmm.
but you're still going to get more than you had. So side hustles are always a good idea, especially if you're just scratching, grinding, trying to make it happen. So I think that's always a good idea and should be supported. But one of the most common mistakes that people make is they think, okay, if I've looked at the brackets, and if I make $10,000 more, I'm in a 25% bracket, and out of this 22%, then all my money gets taxed at 25%, and that's not the case. It's tiered.
Okay.
So, and I don't have the numbers in front of me, but it's a 0% rate up to this, and then from this to this, it's 12%, and this to this, it's 22%, and this to this, it's 25%. So you may be taxed at a higher rate on the last few dollars, but it doesn't go back to dollar one and change your rates for everything. So it's
Okay.
still always a good idea to make more money. Like my grandmother used to say that when she was getting Social Security and working a little bit, she's like, I don't want to make too much money because it'll mess up my taxes, but it won't. I promise it won't. So it does affect it, and you may be taxed at a higher rate on that little bit of extra,
Mm-hmm.
but it's just that little bit. It's not all of it.
Okay. All right.
Does that help?
Are there with side hustles, are there things that you see that business owners don't realize that they need to keep track of that
Yes.
they can claim on their Schedule C?
Yes. So, oh, look at you in Schedule C. So, so if you have a small business like a side hustle and you're filing a Schedule C, that's just a small business tax return that on your return, your personal return, you want to claim. You really, I mean, any expense that business has is a direct reduction of the income. So if you make $10,000 in that side hustle, but you're spending money on gas or supplies or office supplies or things you're doing to make it work, or you pay a contractor to do some work or something like that, all of that money, all of it, the only thing that's reduced is meals. Like if you're taking clients
Mm-hmm.
out or something for lunches, um, you can deduct half of that, not all of it, because they don't want you to feed yourself on the thing. There's a
Mm-hmm.
reasonability test for a lot of things. If you think it's probably not reasonable, it's probably not.
Okay.
But even this last year, they've changed the rules that if you've eaten the meals out in a restaurant, you can deduct all of it, because as a support to a way to support local restaurants and stuff.
Ah, okay.
So, but you want to avoid eating every meal out because that's kind of a red flag. But if
Mhm.
that's a part of your business, yeah, you can take anything that's an expense of that business reduces that income and should.
Okay. And our final question
Already? That was fast.
already, I know. Um, Common deductions that we tend to overlook. What are the things you see the most?
Okay, so this is a funny thing. So when people think about deductions, they think about their mortgage interest and their real estate taxes and any charitable contributions that they give.
Hmm.
And those are the big three that we see. But most people don't forget those things,
Yeah.
because usually two of them are on there on one statement the mortgage company gives them. But so the thing that I always get when I'm preparing someone's taxes is their personal property taxes that they pay every year, hopefully pay every year. That comes out in May and they're due by October, and sometimes
Hmm.
people forget and pay them in January. So the taxes that you paid in the prior year, that's a deductible expense. Now, and any medical expenses, people want to a lot of times think that's something to keep track of, and that's true. But you don't start getting the benefit from medical expenses until it reaches 7.5% of your adjusted gross income. Don't worry about AGI if you don't want me. Just think about if it's not 7.5% of my expenses, it's probably not going to benefit you. So if you make a decent living and you don't have a catastrophic medical event in that year, that's probably not going to benefit you at all.
Mhm.
And so that's not a problem. Now, one thing I want to talk about that was the a couple of years ago with the new tax cuts and jobs act that Trump passed. They raised the standard deduction quite a bit. And as most people know, you take the greater of the standard deduction or your itemized deductions.
Right.
And for 21, the standard deduction is $25,100 for a married couple filing jointly, which are a majority of the people that we see. So if your itemized deductions, your mortgage interest, your real estate taxes, your charitable contributions, if they don't amount to $25,000, then you get no benefit from those at all. So people who think, well, I'll do this because it's a deduction. It may or may not be true. So I've seen some that if they have a mortgage, they're very generous with their money, and they have a lot in taxes, then those things may come out that are deductible. So even if you take, this is one last thing about that. Even if you take the standard deduction, if you've given money to charity in the last year, you can still take a $600 direct tax credit for that. So that's a handy little thing. So it's still encouraging people to be generous with their money, even though they're probably not going to take the itemized deduction. So don't forget to tell your tax preparer that. Also in Arkansas, those itemized deductions, there's no standard deduction in that same kind of way. So those itemized deductions still count. So even if you think you're not going to meet it, still give your preparer all that information because they'll need to use that for your Arkansas return as well.
Okay. So the software for when it comes to the state returns, that software is going to tell the tax preparer we're still going to itemize.
Exactly.
Okay.
And the good software that your preparer will answer all the questions. Usually you enter the stuff once. You tell them what's taxpayers, what spouse, what state they're in. Most of it, like I said, we said this will be Arkansas. And it will prepare that return automatically. And then it's just review and tweaking for small differences that happen state to state.
Okay.
Yeah.
All right. Well, I think that's all the questions we had this morning. So
it's fairly painless.
Hey, we try not to be too painful around here. We want to thank you again for joining us. And I know we've had your website up on the screen throughout the TruTalk. So if anybody owns a small business, needs to ask questions, Trey has a few different options set up within his business to be able to consult or take you on as a client, whatever your needs might be. So
happy to talk to him.
Yes. All right. Well, enjoy the rest of your Friday, and thank you again. And
Thanks for having me. It was great fun.
Yes. We'll have another TruTalk available in a couple of weeks, and we'll be advertising that topic over the next few weeks. So be looking on our Facebook page for more information on that.